All right, and we're live. Let's
Excellent.
kick this off.
Let's do it. So this is Chad Boyle, CPA. I'm here with my younger and smarter brother, Corey. Say
Sure.
hello to everyone, Corby.
Hello, everyone.
There we go. So we are talking tonight about the 13-week cash flow forecast, why to build it, and it really will change everything in your business. So let's just dive right in. Want to go over what we're going to cover. So first off, we will cover some grounding principles just to make sure we're aligned before we get into the mechanics. And then once we talk about the mechanics of the cash flow forecast, we're going to talk about why it's important, what's the payoff. It's some work that needs to be done, and it will be worthwhile, and we'll talk about why that'll be worthwhile. So if we go to the grounding principles, number one is, a lot of things in reporting and tracking for financial purposes or operational purposes, you do a lot of things monthly. Uh, Cash flow forecasting is something you really need to do at a minimum on a weekly basis, and I would even encourage you to have, at least if it's just a near-term view, that it's done on a daily basis. You gotta really be dialed in here to get the ebbs and the flows of your cash flow, because you really want to identify any sort of red flags that you may have as far as like low cash periods. Then you got transactions coming in all the time, right? You're purchasing materials, you're paying subcontractors, paying crews, you've got your payroll that you're paying. So a lot of transactions. This isn't something you want to update on a monthly basis. Really needs to be done kind of from a comprehensive basis, like every week. And then one of the keys to driving the confidence in using the cash flow forecast as a tool is that you know that it always ties back to your bank balances. So you see the bank balances, you see those in your cash flow forecast. So you're confident that you can make good decisions because it's based on reality and what's in the bank and what you are projecting is going to be coming in and out of the bank. So I think that covers our grounding principles. Keep those in mind as we kind of talk through this. Now, if we go to the mechanics, like, okay, how do we get down to it? Like, what are kind of the parts and pieces, and how do you build this? So this is kind of an aggregated layout here of kind of the parts and pieces, right? And so if we look at the categories that you're going to have cash inflows. So this is, payments that you're collecting from customers as you collect your receivables. Cash outflows, this is going to be anything that you're paying, right? Your payroll, materials, subcontractors, that's going to go in your cash outflow bucket. And then the difference between those two is your net cash flow. So if your inflows are more than your outflows, obviously that's going to be a positive net cash flow. And then the bottom row is kind of what you want to focus on and look at, which that's your ending bank balance. So you can see here, week one, we're going to end with 84. And then week two, you got a net cash flow that's negative $2,000. So your ending balance there is going to be 82. So that's what you want to look at that after you get all your inflows and outflows in here, and you're tracking this. Make sure that, let's just say week one was last week. You know that ending balance of 84,000. You can actually see that in your when you log into your online banking, and you can see that 84,000. So that's kind of the mechanics of kind of how this is built out. Now, obviously, like you don't want to track this kind of at this macro level. Like for all the inflows, you're going to want to have like customer payments, and then outflows. You're going to want to detail this out by line item so that you can forecast it and then update it on that specific line item so you can track each one of the cash inflows and outflows. Very, very important. Now, I got really good at this doing this for my personal finances. When I was like in my 20s and didn't have any disposable income and it was important. I still don't have any disposable income, so I still have to do this, but I think the numbers are bigger and I just have more to keep track of. But it's kind of the still bottom line result. So this is very important from a business perspective, no matter how big or small your business is, how many jobs you're doing. Depends on how many bank accounts. Like there are tools out there that you can use that you can aggregate accounts across multiple banks. It just depends on how complicated your banking situation is. So this can be done in Excel offline, or there are tools where you can bring in bank feeds and kind of aggregate everything. Makes it a little bit easier to automate. So again, cash inflows, this is kind of what you're going to look at, and you're going to want to have a line item for each one of these things. So this is collections, other cash in. I don't know, maybe you got a insurance claim for some piece of equipment that went bad on you, or maybe you sold a couple dumpsters that you had laying around that you weren't using anymore. That'd be other cash in. So these are kind of just some of the cash inflows, for example. Then the outflows, obviously payroll, labor, your operating expenses, supplier payments, so your materials, then anything else. You also want any sort of like owner distribution. You want to make sure that this is all you got to capture everything. So at the end of the day, everything that runs through the bank account will need to be a part of your cash forecast. And then in a situation where you have multiple bank accounts, which let's say you have one that where all your incoming customer payments come into, you have another one for all your AP, all your disbursements. You just want to make sure that you bring all the bank accounts in. You just want to make sure you keep track of all the transfers to and from, because at the end of the day, it's all your money and it's all rolling into the same financial statement, but all the transfers should balance out to zero at the end of the day. And like we talked about in the guiding principles, everything has to reconcile the bank account. So all the activity has to be tracked in the cash flow forecast. That way, your beginning balance matches up to the bank statement. Your ending balance matches up to the bank statement. That way you are tracking all of those items and you have a forecast for them. So that way your cash flow forecast is going to be as accurate as possible. So let's just talk about kind of why this changes everything, to track and to have this cash flow forecast to use as a tool in your business to help with make decisions, to use as red flags. And then really when you make those decisions, this is going to be the thing that gives you the confidence that you can make those decisions and it's going to be something that is going to be beneficial for your business and not be some cash drain. So obviously, if you don't have a forecast, like you're managing to, check your banking app in the morning, you're really not going to have a perspective on kind of what's coming in, what's going out, and how that balance that you see is going to change. So that it just gives you the visibility that you need in order to make the decisions, whether you want to buy a piece of equipment, you want to make another hire, bring on another crew. Maybe you want to, maybe you get a deal on some turf or some sort of material, some lighting that if you buy it in bulk, you can get a better price on it, which that would be inventory. That's going to be a big outlay of cash, but the savings will be realized as you put those materials into jobs. But if you don't have the cash flow forecast, you're not going to know if you can absorb that right now without causing you a problem. So you'll be able to see kind of with the forecast, you'll be able to see periods where you're either getting low or you're going negative. And if you're looking at a daily forecast or a weekly forecast, going negative isn't necessarily it doesn't necessarily mean that it's a bad thing. It just means that you need to look at your timing of expenses versus the cash inflows. Make sure you're confident in where you have those set, and you just may need to adjust things around to balance it out, right? So if one week is negative, maybe you have to hold off on paying something. Now, some things you can't move, right? So you got to have the money there for payroll, but maybe it is one of these large material purchases you're considering, or you're going to buy a piece of equipment. Perhaps you can push that off for a week or two just to balance out the cash flow. It kind of helps you make decisions about strategically when you're going to have money going out, and it's really based on when it's coming in and what you have. So that's where the confidence comes in, that like you're doing the math and you can see where there could be red flags. Anything else to add there, Corey, on the with a forecast, without a forecast? How we doing?
No, I think we're good. I mean, I think if you flip to the next slide, I think that's where it summarizes it. And I just want to double down on how much confidence and decision support that the cash flow forecast can give you. I mean, even for us, I mean, I found it extremely valuable to be able to look, those 13 weeks ahead of time and see what our cash is doing, and really helps us make decisions on where we're going to invest, where we need to hold off. So I can't. I'm a big fan of the cash flow forecast.
That's right. That's right. Well said. Well said. Yeah, these are just some of the decisions or questions you might be asking yourself, um, and the cash flow forecast is an indispensable tool in making these decisions. So I think as we kind of wrap up, here's a summary. So again, you know, look at a weekly period at a minimum. Daily would be great. Again, it all comes down to, like, the frequency of inflows and outflows that you have will kind of drive that. Most people can get away with weekly, but it wouldn't necessarily be bad to do daily. And then you got to really keep this thing updated. Every week would be a minimum. And again, it all kind of depends on, the level of detail you're working with, how many bank accounts, how many inflows and outflows, and then always tie that back to what you're seeing in the bank account, because that's what's going to give you the confidence that you have everything accounted for.
And
Anything
one of the
else?
things I think that maybe you haven't touched on yet is actually, I mean, you say keep it updated daily, weekly, but I mean, we're not talking about hours of work here, right?
Correct.
This
Yeah, I
is more.
mean, yeah, this is, yeah, you're not sitting at a computer, doing all kinds of crazy Excel formulas and or what have you. It's really just looking at the transactions, updating those in your cash flow model as they come in. So, some days you're going to have a handful that may be two or three transactions. Some days, maybe that day of the week where you pay your subcontractors, there may be more transactions that you have to deal with. But you could roll all the if you pay 20 subcontractors, you can roll that up in one line. um, you can choose to do that, so it's not so cumbersome. So there are some ways to have the detail that you need, but still make some shortcuts to where it's practical and you're updating it on a daily basis. Which, yeah, to your point, Corey, is probably a 15-minute exercise once you get the process down.
Yeah, and I would say well worth the investment of that time in terms of the amount of confidence and decision support that you're going to get out
Yeah,
of that.
definitely. Yeah, and I think, like, you update that, and probably a lot of people take at least some time, once a week, just to go over their calendar, and just kind of regroup on what happened in the last week, what is coming in the week ahead, just to kind of reset and plan for themselves. That'd be a great time to just kind of look at your model and say, okay, I've updated my model. Here's what I have upcoming. Do I need to make any sort of decisions or change some cash flows around? So that's it's always good just to review that on a regular basis, just to know that, again, you want to stop reacting, you want to start planning. So use that time on a weekly basis to plan out what your cash flows you think are going to come in, so that you can make some adjustments as needed. So if you like this, and you want this built for your business, or maybe you have some questions about how you can build this for your business, we're here for you. All you have to do is just go to ascendfts.com, book a 30-minute free call. We'll walk you through the process, answer any questions you have. Ascendfts.com. You just go there. There's a big blue button says book a free consultation. It's in the top right corner of the site and somewhere near the middle. I promise you, you can't miss it. I think that covers our 13-week forecast. Anything before we wrap up, Corey?
No, I think we covered it all.
Awesome.
It's exciting.
All right. Well, get your cash flow forecast built, make decisions with confidence, and grow your business. And check us out at ascendfts.com.
All right, great. Thanks a lot.
Thanks, everyone.